The brief window of stability that characterized the early weeks of April has been abruptly curtailed by a resurgence in mortgage market volatility. While Freddie Mac's most recent weekly survey recorded a 30-year fixed purchase average of 6.30%, real-time market indicators today, Tuesday, April the 21st, 2026, suggest a sharp reversal. Daily lender data points to refinance rates surging toward 6.75%, with purchase rates trending notably higher than last week's figures. This shift represents more than a mere technical adjustment. It constitutes a significant disruption for market participants who had begun to adjust their outlook toward a lower interest rate floor. The primary catalyst for this movement lies in broader macroeconomic pressures, specifically the persistence of energy-driven inflation and ongoing geopolitical tensions in the Middle East, both of which are exerting direct upward pressure on the domestic cost of credit and shelter. For homeowners and prospective buyers, this volatility introduces a period of profound uncertainty. The recent dip to 6.30% in mid-April had prompted a 5% increase in refinance activity as borrowers sought to capitalize on the lowest rates observed in several months. However, the subsequent jump in daily rates by nearly half a percentage point has effectively narrowed the window for reducing monthly debt obligations. This sensitivity underscores the fragile state of the current lending environment. Mortgage Bankers Association data reveals that while refinance activity saw a temporary surge, purchase applications declined by 1% week over week. This divergence suggests that while current owners are moving quickly to act on rate fluctuations, prospective buyers remain largely sidelined, deterred by the confluence of elevated borrowing costs and record-level home prices. The National Association of Realtors reports a median existing home price of $408,800 for March, a 1.4% increase year over year and a record high for the month. When these valuations are paired with mortgage rates again approaching 7%, the impact on affordability becomes stark. The Housing Affordability Index fell from 117.5 in February to 113.7 in March, highlighting a persistent barrier to entry for the typical American household. Even as inflationary pressures in other segments of the economy show preliminary signs of cooling, shelter costs remain stubbornly elevated. As long as global energy supply disruptions sustain current price levels, the Federal Reserve appears unlikely to find the latitude required to implement meaningful reductions to the federal funds rate in the near term. This high interest rate environment is compounded by a chronic supply deficit. Total housing inventory remained at 1.36 million units at the end of March. While this equates to a 4.1-month supply, an improvement over the 3.8-month supply observed in February, it remains well below the 6-month threshold typically required to achieve a balanced market. The National Association of Realtors estimates that an additional 300,000 to 500,000 active listings are necessary to reach equilibrium. The primary impediment remains the lock-in effect. A significant majority of existing homeowners hold mortgages with rates below 4%. Consequently, the financial disincentive to trade those terms for a 6.75% mortgage is substantial. This dynamic maintains inventory levels at approximately 30% below historical norms, effectively sustaining a cycle of constrained supply and elevated pricing. The new construction sector is also showing signs of fatigue. While the U.S. Census Bureau's report for March indicated a marginal 1.6% gain in housing starts, the leading indicators are less favorable. Building permits, which function as a proxy for future construction activity, declined by 4.7%, and single-family starts have retreated to a 9-month low. Developers are navigating a complex calculus. Higher financing costs increase project expenses, while declining buyer affordability threatens absorption rates. In response, there has been a strategic pivot toward the multifamily segment, which saw a 30% surge in starts, as demand for rental housing remains resilient despite the broader decline in homeownership affordability. Regional data further highlights the systemic nature of these pressures. Although home sales declined across all 4 major U.S. regions in the last reporting period, a geographic divergence in resilience is apparent. The South and West maintain stronger relative performance metrics compared to the Northeast and Midwest, even as total national sales volume contracts. This indicates that while elevated rates act as a national headwind, regional economic conditions and migration trends continue to influence local market performance. Nevertheless, no region remains insulated from the overarching impact of Federal Reserve policy. The most recent Beige Book suggests that housing activity has moderated across several districts, with the central bank citing pervasive uncertainty as a primary factor. This uncertainty is further intensified by the pending leadership transition at the Federal Reserve this May. Market participants are currently adopting a cautious, observational posture while awaiting policy clarity from the incoming chair. While consensus expectations favor the central bank maintaining steady rates, the geopolitical landscape may necessitate a more prolonged restrictive stance. Rising crude oil prices resulting from conflicts in the Middle East influence both building material costs and transportation expenses. Should energy costs remain elevated, the shelter component of inflation may prove resistant to decline, thereby limiting the Federal Reserve's capacity to execute the rate cuts many anticipated for the second half of 2026. Looking ahead, institutional outlooks have become increasingly conservative. Major analysts, including those at J.P. Morgan Research, now project that national home prices will essentially stall, ending 2026 with flat growth. While this price stabilization might offer some relief, it does little to address the broader affordability crisis while mortgage rates persist in the mid to high 6% range. The National Association of Realtors has similarly adjusted its annual sales volume forecast, now projecting a 4% increase, a revision downward from previous estimates of 5% or higher. The lending environment is expected to remain characterized by hypersensitivity to economic data releases. Prospective buyers have shown an increasing reactivity to even minor 20 basis point shifts in rates, which creates the current pattern of erratic movement in weekly application volumes. For the individual borrower, the variance between a 6.2% rate and a 6.75% rate on a median-priced home represents a substantial difference in monthly payment obligations, frequently serving as the threshold between securing financing and being priced out of the market. This volatility continues to sideline a broad segment of the buying public, leaving the market increasingly dominated by cash buyers or those with significant existing equity. For renters, the landscape remains equally challenging. While the rise in multifamily starts indicates that increased supply is in the pipeline, it will require significant time for that inventory to reach the market. In the interim, high energy costs and subsequent service sector inflation continue to exert upward pressure on rent prices, even as growth rates moderate in certain metropolitan areas. Sustained high costs for homeownership further incentivize would-be buyers to remain in the rental market, thereby supporting demand and preventing a broader correction in rental rates. In summary, the U.S. housing market on this Tuesday, April the 21st, 2026, occupies a position defined by macroeconomic forces largely beyond its internal control. The promise of rate relief that appeared earlier this month has been tempered by the realities of global energy markets and a cautious monetary policy. The current trajectory points toward a period of stagnation in both price growth and sales volume as the market awaits definitive signals from the Federal Reserve and clarity on international geopolitical developments. Observers will be closely tracking upcoming inflation reports and the transition in Federal Reserve leadership next month for indicators regarding the future of borrowing costs. Until then, the housing market remains in a state of fragile recovery, where gains in supply are consistently countered by the rising cost of credit. Homeowners, buyers, and industry professionals are entering a summer season defined more by volatility than by the anticipated seasonal expansion. This remains the prevailing state of the American housing economy, a market seeking stability within an increasingly volatile global environment.